Hello everybody and welcome to another video on financial analysis, and in this video we are going to be looking at a company called Contour Global. Now Contour Global, if you've never heard of them, this is what they do. They are a FTSE 250 company. They are a British power generation business. They're listed on the LSE and part of the FTSE 250. Okay, so British power generation, that's the business that they are in. And today we are going to be looking at some financial analysis. We're going to be looking at the annual report and accounts of the company and seeing what we can find out about them. Now, this comes at the request of one of our subscribers. I got an email through. I've been enjoying your YouTube channel. Thank you very much. You've got some really good content here. Thank you very much. Deserving of a wider following. Good. Don't forget to like, share, and subscribe. So do share this content if you think it is of use to your friends and colleagues. Interesting stock in the Telegraph recently, Contour Global. So it's a stock tip in the Daily Telegraph with a good business model, good earnings, growth, high dividend. What confused me though is how any stock that's trading on a PE of 130, which makes it sound pretty expensive, can generate dividend yield of 6.5%. Interested in your perspective. Not a single investor review seems to focus it. Have I missed something? This is from Andrew. So Andrew, this analysis, this video is for you. So just before we jump into the financials, do remember, like, share, subscribe. If you subscribe, you obviously get notified of the video that we do for you. And if you can share it, then obviously we get a wider offering, which is fantastic. So without further ado, let's jump in and have a look at the financials. One caveat before we do go in. Please do remember, this is financial analysis. We'll look at the financial statements. They are by their very nature backward looking. So if you are using this video for investment purposes, this does not mean that you don't have to do any other research in terms of the market, where these guys are going, the contracts they're signing, etc., etc. So if you want to tell me my analysis is out of date, that's more than welcome to do so in the comments, but please do be polite. So let's have a look at the numbers. So here is the financial statements. Nice glossy pictures on the front. This is available on Contour Global's website, and you can read all about the company and what they're up to and what kind of power they're generating and how they're generating it, etc., 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 if you so wish, which you probably should do if you are looking at investing in these guys. However, we are going to limit ourselves to the annual report and accounts, so we're going to stick to the actual numbers. So here's the audit report and the director's report. We're going to whiz all the way down to the numbers which are here. So here we are on the consolidated income and other comprehensive income, so the profit and loss account or the income statement. And we notice, first of all, that this is in dollars. So we're reporting in dollars in millions. And top line is a nice growth from 1.3 billion last year to 1.4 billion dollars turnover this year. Cost of sales is about $1 billion, leaving them with a gross profit. Here, gross profit it's a 27% gross margin. Now, I'm not that familiar with the power industry, so I couldn't comment on whether that's a kind of a good gross margin or a bad gross margin, but it sounds all right to me. That's the kind of the cost of generating all that power. They've then got relatively low SG&A. This is the sales, general, and administrative expenses, or the overheads. And they've got a little bit of other costs coming here. I'm interested in this one. They've got some acquisition-related costs, which I'm not exactly sure what they are. Maybe 4.5 will give us a little bit more note. That could be sort of bankers' fees, for example, or it could just be restructuring costs within there. But we'd expect those to go away over the next few years. They made an acquisition last year, and they're kind of just embedding it down effectively. Interesting, they've got some other operating expenses. Again, you can go and have a look at note 4.3 if you want to kind of find out a little bit more about those as to why they're not classified in the SG&A. But these guys, they're operating. The operating profit is increasing, and they are maintaining a steady 22% operating margin. Finance costs pretty high. They got quite a lot of debt obviously sitting on the balance sheet, and we'll see that a little bit later on. and down to the net profit. So net profit looks reasonably flat, a little bit of an increase in the net profit, and it's a 2% margin. Now, 2% margin, there's not a lot of room for error there. There's obviously a lot of debt sitting on these guys, and the debt is quite expensive. You know, do we want to see interest rates go up? If interest rates go up, the cost of that debt is going to go up, and it's going to become increasingly hard to service. Don't forget, interest rates right now, certainly here in the UK, are historically low. They've never been this low since 1694, when the Bank of England was founded. So net profit is pretty low. Now, what I found quite interesting here was looking at the earnings per share. It just jumped out at me. Earnings per share is actually quite low, but it's actually halved since the previous period. So what was interesting was that the company's making the same amount of profit, yet the earnings per share has halved. And the only reason I can think of for that is if the number of shares have doubled. And actually, I don't think the number of shares have doubled. What I think is driving it is this the profit attributable to the shareholders of the company. So this company is, you know, we're looking at the consolidated. There are there are other companies within this kind of, you know, this group of companies. These guys, they don't own 100% of all of that group, so there's going to be parts of the business where other parties own part of it, and it looks to me like, well, you know, you could effectively say that, you know, pretty much half of the profit is actually attributable to non-shareholders. So if you buy a share in this company, you're not buying $28.6 million, you're only buying $16 million. And it was just interesting that difference is fairly substantial. So the minority interests, as we call them, their share of the profit has gone from a loss of 4.6 million last year to $12.6 million this year. Okay, just a little bit of a flag there. I'm not sure exactly what is driving that, but it looks like where the profits were made last year to this year has shifted, and therefore there's an external party who's really benefiting from that. And obviously that's no doubt done all at arm's length, as you would expect. So let's go on to the balance sheet. So in the balance sheet, non-current assets, big number in non-current assets is the property, plant and equipment, as we'd expect from any power generator business. 3.5 billion of kind of, you know, power stations and kind of, you know, all that kind of infrastructure that's doing it, and that's really driving most of it. You'll notice that kind of they put the total is at the top of the column rather than the bottom of the column. It caught me out, I have to admit. Down here in terms of the current assets, you know, we got some inventories in there, some trade and other receivables, quite a lot of cash, $1.4 billion. So we'll look at the cash flow, but, you know, it looks to me like these guys are quite comfortable in terms of their cash. A little bit further down, come down to the liabilities side. In the current liabilities, so the current liabilities, liquidity is not an issue. Just quickly highlight that while we're making that transition. So there's the current assets. Compare that to the current liabilities, our kind of traditional liquidity ratio. Liquidity doesn't look like an issue, but if we do look at the current liabilities, what we do see in there is quite a big number is the debt, and that debt has increased by over $600 million, and that's the short-term debt as opposed to the long-term debt. Now, lots of debt, lots of interest, and we talked about that when we looked at the income statement. Can they afford that interest? Yes, they can at the moment, but if interest rates double and then double and double again, these guys are going to find life gets very, very tough indeed for them. So lots and lots of debt, and we see that debt is increasing. So you know, they're taking out loans, and they're not going to be able to do that. You know, I'm kind of feeling they've got to be getting very close to, you know, maxed out on the debt. I'm not sure that, you know, I would personally want to be kind of, you know, lending a much more to this company, because you can start to see the debt to equity. And I'm not saying that this is wrong, because, you know, power companies, you know, they're pretty solid, pretty stable. You know, they kind of to generate the power, we need to buy it to heat our homes, etc., etc. So it's a pretty safe business, and therefore traditionally, and with lots of assets, therefore traditionally they do use lots of debts, but there's a limit to everything. Let's just put it like that. So lots of debt, and in the equity section, we see there's lots of retained losses. So these are the retained earnings or the retained losses. Now, interestingly enough, obviously we sort of said, well, hold on a second, this company made a profit of about 28 million, and yet it's booking a loss. It looks like the losses, it's got retained losses sitting in there, and that's going to be those dividends that Andrew was referring to. So let's go and have a look at those. If we go into the movement in equity, we are interested in this column here. This is the retained earnings, and what we see here, so this is the current year, sorry, this is the previous year. So this is 2019. They made a profit of about 28 million dollars, and they paid out $137 million in dividends. So Andrew, there is your dividend yield, and so in effect, the retained profits have fallen from 233 to 180. And then if we look at 2020, just scroll down a little bit and we can see the 2020, they start, obviously finished last year with 180, start this year with 180. There's the profit. So here we see quite interesting. There's the profit for the year, but actually a significant chunk is allocated to those minority interests. That's what this column here is. This is all minority interests, and the shareholders, i.e. you guys, if you are a shareholder, if you're an investor, you only get 16 of that profit. So 16 of that profit, there it is there, and then they're paying out 105, and they're down to 198. Now, it doesn't take a genius to work out that they're not going to be able to pay out that dividend, or at least they're not going to be able to sustain it at that current level. They can't do 137 this year, 105, 137 last year, 105 this year. They've only got 98. They can't carry on to paying out that dividend. So that dividend yield is not a long term. And this we would typically use what we call the dividend cover, and the dividend cover is merely comparing the profit to the dividend and looking at the sustainability of that profit. Of that dividend, and certainly I would suggest that at a 0.27 dividend cover, it really needs to be above 1, and with a bit of a comfort factor above 1. I don't think that dividend is going to be sustainable. Also quite interesting, as they're taking on debt and paying out dividends, and again there's a kind of little bit of a misnomer going on there. So let's go and look at the profit, the cash flow statement. Here is our cash flow statement. So they are generating cash. That's good. $720 million. That's nice. Bit of an investment going on. You'll notice the previous year, there's the acquisition of a subsidiary. So again, I haven't investigated that in detail, but that's part of that kind of, I think that kind of that acquisition costs is just embedding it down and making sure all the IT systems talk to each other, and kind of the processes, etc., etc. So the financing, though, I think is quite interesting. If we just scroll down a little bit further, so here are the dividends paid. And if I was a betting person, I would suggest that you're not going to be seeing that. I mean, they may pay out 100 million next year, but I don't think they're going to be paying that out for much longer unless they really do strike gold. Here is the proceeds from the proceeds from the borrowings we need to read together with the repayment of the borrowings. There's a little bit of refinancing going on there, but you can see on a net basis that debt has increased by 600 million, and there's a similar story the previous year. Debt has gone up by about 500 million. So these guys have been taking on more debt, and you can see the costs of that debt is fairly substantial. Cash distribution to non-controlling interests. So this is dividend payments to the non-controlling interests. This is cash distribution, dividends to non-controlling interests, etc., etc. So all of that is kind of, again, this kind of these the non-controlling interest within the group. So the kind of basically that our summary is that these guys, they're generating cash, a little bit of investment going on, they're borrowing lots of money, and because they're borrowing so much money, they're generating extra cash. The cash has gone up during the year, and they've now got 1.4 billion sitting in the bank. So, you know, they're not going anywhere. It's a pretty strong balance sheet. I just scratch my head and think about all of that debt. So if we are looking at the debt, you know, the debt to the equity, you know, they have a very, very high amount of debt. That's sort of 48 billion of 58 billion. I mean, that's over 90% debt funded. So, you know, these guys really have got about as much debt as they can afford, I would expect. Yeah, so 93.5% debt funded, which is a lot. And often we look at some people look at the debt to EBITDA, the net debt to EBITDA, so that's the debt less the cash to EBITDA, and just see how quickly they could repay that debt. And these guys, it's about 5.5 years. So in terms of their EBITDA, if they said we want to go debt free, it's going to take them 5.5 years, and that's quite a long time. Again, it would be useful to benchmark that within the industry, but these guys, you know, they're not going to be taking out a lot more debt. I don't think. That's my personal opinion. So I think that's going to be driving the dividend per share that our friend Andrew was referring to. Nothing else really to kind of, you know, to highlight. You know, I mean, interesting enough, if we look at if we go back to the share price, the share price I looked up actually didn't give a P ratio, and I'm not sure why it didn't give a P ratio, and it may be a kind of a recent, it's based on the most recent earnings, and that suggests that maybe the recent earnings they've made a loss, which would certainly negate any future dividend. Dividend yield there is 6.3%. Which is obviously very, very high. And if we take it as a proportion of earnings at the end of 2020, they're kind of their net earnings. And don't forget, I've based it on net profit, not net profit attributable to the shareholders of the company, then it's 45 times. If you actually look at the profit attributable to the shareholders, you're up about 90 times earnings. And 90 times earnings is very, very expensive. Especially for a company which is, well, I mean, you know, they are growing, you know, there's 6% top line growth there, but I'm not sure that this is kind of, you know, they're a big pack, you know, they're not a leverage play like a tech company, for example. So you can see the share price, it's been bouncing around a little bit. If you're an investor, then you're going to probably have pretty tight underpants to kind of, you know, to survive that. If you're a day trader, you've probably quite enjoyed it, either that or you cry into your coffee each morning. So I guess the sort of sum total is, you know, Contour Global, probably not for me. So there you have our analysis of Contour Global. I hope you found that useful and interesting. Once again, do share your comments. If you'd like to tell me a little bit more about the organization, what you know about it, then I'm always open. Please do use the comment section. Obviously, please do be polite when you use the comment section. And once again, don't forget to like, share, and subscribe to the channel. And I look forward to seeing you on the next video.